Today, we're covering 15 essential things you need to know before investing in bonds. Bonds can be a great addition to your portfolio, providing stability and income, but they work differently from stocks, so it's important to understand the basics. Let's jump right in. This is Wealth Velocity. Here you create, protect, and grow your wealth fast. A bond is essentially a loan that you, the investor, give to an organization such as a company or government. In return, the issuer promises to repay the principal, or face value, on a specific date, known as the maturity date. During the bond's term, you receive interest payments, also called coupon payments, at fixed intervals. Understanding that a bond is a debt instrument is essential. Unlike stocks, where you own a piece of the company, bonds make you a creditor. This means you're entitled to repayment before shareholders if the issuer faces financial issues, giving bonds a typically lower risk profile compared to stocks. Stocks represent ownership in a company and have the potential for high returns through price appreciation. Bonds, on the other hand, are debt securities and are generally seen as safer because they offer fixed income in the form of regular interest payments, rather than relying on market-driven price gains. Bonds are often used to balance a portfolio by adding stability. Stocks can be more volatile, while bonds offer a predictable income stream. Knowing the difference helps you understand how bonds can act as a cushion during stock market downturns. There are several main types of bonds. Government bonds are issued by national governments, like U.S. Treasury bonds, and are generally considered very safe. Municipal bonds are issued by local governments or cities and often come with tax benefits. Corporate bonds are issued by companies and offer higher returns than government bonds, but with added risk. Treasury securities include treasury bills, notes, and bonds, each with varying maturity periods and risk levels. Different bonds serve different purposes. Government bonds might be suitable for safety, municipal bonds for tax benefits, and corporate bonds for higher returns. Knowing these types helps you choose the bonds that best fit your investment goals and risk tolerance. The maturity date of a bond is when the issuer repays the principal. Bonds come in three maturity categories. Short-term bonds, which are 1 to 3 years, offer lower risk but also lower returns. Medium-term bonds, spanning 4 to 10 years, provide a balance between risk and return. And long-term bonds, those over 10 years, typically offer higher yields but are more sensitive to interest rate changes. The maturity of a bond affects its stability and yield. Short-term bonds are less sensitive to interest rate changes, while long-term bonds may offer higher returns but can fluctuate in value. So, choose maturity lengths based on your financial timeline and risk preference. A bond's yield is its return on investment, based on both the bond's interest payments and its current market price. There are different yield calculations, including current yield and yield to maturity, or YTM, which takes into account the total return if you hold the bond until it matures. Yield is essential for understanding a bond's income potential. Higher yields may be attractive, but they often come with higher risk. Balancing yield with bond quality can help you build a stable, income-generating portfolio. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. This is because new bonds are issued at the current rate, making older bonds with lower rates less attractive, which lowers their price. If you plan to sell your bond before it matures, interest rate changes can impact its price. Knowing how interest rates affect bonds helps you make informed decisions, especially if you're considering long-term or high-yield bonds, which are more sensitive to rate changes. Credit rating agencies like Moody's, Standard & Poor's, S&P, and Fitch assess the creditworthiness of bond issuers. Bonds are rated from high, like AAA for very safe, to low, such as C or D for high risk, and fall into two categories: investment-grade bonds, which are safer but have lower yields, and high-yield or junk bonds, which are higher risk but offer higher yields. Credit ratings help investors assess the risk level of a bond. High-rated bonds are safer but offer lower returns, while lower-rated junk bonds can offer high returns but with greater risk. Understanding ratings is key for managing risk in your bond investments. The coupon rate is the fixed interest rate the bond pays based on its face value, while yield to maturity, or YTM, considers the total return if you hold the bond to maturity, factoring in the price you paid. YTM gives a more accurate picture of a bond's potential return, especially if you bought it at a discount or premium. It's a valuable tool for comparing bonds and understanding your total potential return over the bond's life. Interest from bonds is generally taxable, but municipal bonds are often exempt from federal income taxes, and sometimes state taxes, if you live in the state where the bond is issued. Treasury securities are exempt from state and local taxes. Tax benefits can significantly impact your overall return. For high-income investors, tax-free municipal bonds may be attractive, while Treasury bonds can be advantageous in states with high taxes. Understanding the tax implications helps you make more tax-efficient investment choices. Inflation risk, also known as purchasing power risk, occurs when rising inflation reduces the real value of a bond's fixed interest payments. Long-term bonds are particularly vulnerable to inflation, as future payments lose value in real terms. Inflation can erode bond returns, especially with long-term bonds. Treasury inflation-protected securities, or TIPS, are designed to combat this by adjusting the principal for inflation, making them a good choice if inflation is a concern. Some bonds are callable, meaning the issuer can repay the principal before the maturity date. Companies might call bonds if interest rates drop, allowing them to refinance at a lower rate, which leaves investors without their expected future income. Callable bonds can disrupt income plans since they may end sooner than expected. Callable bonds usually offer higher yields to compensate for this risk. If stability is a priority, look for non-callable bonds to ensure the bond will last to maturity. Liquidity refers to how easily you can buy or sell a bond without affecting its price. Government bonds like U.S. Treasuries are highly liquid and easy to sell. In contrast, some corporate and municipal bonds may have lower liquidity, making them harder to sell quickly. Liquidity is important if you might need to access your money before the bond matures. Illiquid bonds can be harder to sell without taking a loss, so they're best suited for investors who can hold them to maturity. Bond laddering is an investment strategy where you purchase bonds with staggered maturities, such as 1, 3, 5, and 10 years. As each bond matures, you can reinvest the principal in a new long-term bond to maintain the ladder. A bond ladder reduces interest rate risk and provides regular income. It's a flexible strategy that allows you to reinvest or access cash periodically without disrupting your overall portfolio, offering balance between short-term liquidity and long-term returns. You can buy bonds through a brokerage, a bond mutual fund, or an ETF. Treasury bonds are also available directly from the U.S. government on Treasury Direct. Brokerages may charge fees and have minimum investment requirements, so compare options before buying. Different buying methods offer varying degrees of access, cost, and diversification. Bond ETFs or mutual funds provide instant diversification, while direct bond purchases give more control over individual bonds. Understanding these options helps you choose the best fit for your needs. Bonds add stability and income to a portfolio, balancing the volatility of stocks. A common rule of thumb is to invest a portion of your portfolio in bonds equal to your age. For example, if you're 30% of your portfolio could be in bonds. Having bonds in your portfolio can reduce overall risk and provide predictable income, which can be especially valuable as you near retirement. Balancing bonds with stocks helps create a resilient portfolio that aligns with your financial goals and risk tolerance. And that's it. 15 things every beginner needs to know before investing in bonds. Bonds can provide stability, income, and diversification, making them a valuable part of many portfolios. If you found this video helpful, please like, subscribe, and share it with anyone interested in learning about bonds. Thanks for watching and happy investing!